Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's May the 24th, 2016. Certainly trust you all had a great long weekend. The weather was certainly amazing, so it's nice to have some warm, sunny days. Well, I wanted to update you in terms of the stock market and just our view on what's happening and sort of the opportunities that we see in the marketplace. I think, as most of you know, we're very careful, we're very cautious, we're very concerned about a lot of big picture challenges out there in the global economy. And we're not alone. There was an investment professional, Stanley Druckenmiller, who's a very good professional, hedge fund manager over 30 years with one of the best track records, who gave a very interesting presentation in New York back in April last month. And I just wanted to speak to 6 slides that he presented at the conference that we've pirated basically, but I give him all the credit for the slides. But I think that they help us talk about some of the key issues out in the market and why we want to be careful, why we need to be conservative and be alert and looking for opportunities, as they certainly could arise with market volatility. So the first slide that is just up on your screen there, that says, "Is the best behind us?" And this is a very interesting slide, and I'm just going to give you just a quick over on each of these slides because of time. But here you can see that the blue line, which goes up from the bottom left-hand side to the top right-hand side, that's a logarithmic line. In other words, it's growing exponentially, and that's the S&P 500. So you can see that the S&P 500 has really been compounding at quite the rate since the 1970s. This goes back to the 1970s. You can see the tremendous growth, especially in the 90s. And again, this is a logarithmic chart, so it's showing, true compounding. The other line, the gray line, which is a little lighter, are the interest rates. That's the 5-year interest rate on the government debt called Treasury in the United States. You can see that rate, which peaked, as many of you know, in the early 1981-82, has just been plummeting ever since and has now reached basically record lows. The point of this is that as interest rates go down, they help put stock prices and the value of assets up. This divergence cannot continue to happen much further. So this is, again, it's just be cautious. Rates are really low. As we know, they're trying to put them negative. We're going to have to be very careful about where all this takes us, and therefore we want to be vigilant in terms of the quality of companies we're buying and the prices that we're paying. Now, the second slide that is going up on your screen, that says little room to increase debt. Now, this is a chart that you've seen us put up many times, and this chart pertains to the United States, and it's the debt to GDP ratio. And you can see this is be all total credit, so this would be not just the government, but also corporate and personal. And you can see that now is, it's approaching 400%. So it's a big number, but that chart puts it in perspective. So you can go back and you can go all the way back to the 20s, and you can see where that number, went up in the Depression and the war years and so forth. It came down afterwards, and you can see where we are today. Again, we are at levels that are really high, and that's consistent with Canada, the Western Europe, Japan, and so forth. So debt levels as a ratio of the value of your economy, the total productive value of your economy, measured by GDP, is really stretched. So again, we want to be careful. The third slide says peak in profits is past. Now, this is important because, as you know, when you're looking at equities, you want to be buying equities where profits are increasing. And as profits increase, the value of the stock should go up because it's the value of the profitability and the future profits of the company. Now, this slide's showing that total debt, especially the last few years, if you look at just the last 3-4 years, total debt has continued to go up in terms of non-financial, so non-banks, non-financial companies, so all the various corporations across all the industry sectors. As debt has gone up, actually EBITDA, which is earnings before interest, taxes, depreciation, and amortization, so it's a measure of earnings, has actually been going down. And we're seeing that even this year so far, that earnings really haven't been growing. In many cases, actually have been shrinking. So this is a problem. If you have debt going up but earnings actually not increasing, then stock prices just, they're going to have a tough time going forward. So we want to, again, be careful, be vigilant about the kind of companies that we're buying. The fourth slide also talks a little bit about this allocation of capital within companies. And we've talked about this before. With interest rates at record lows, companies aren't making the long-term investments that you'd expect them to make. Instead, they're often piling on debt and then just buying back stock or buying competitors, doing acquisitions. And this chart, called misallocation of capital, is very, very helpful and instructive in showing you what's been going on. The green part of the chart that you see would be the accumulation of cash, and that would be companies that are, accumulating cash and then making capital expenditures. So those are long-term investments. So wherever you see green, you see long-term investments. Where you see purple, that's when companies are simply just buying back their stock and shrinking the shares outstanding and then increasing their earnings as a result of just buying back their own stock. That's not long-term investment. And if you also look at that purple, it also incorporates just buying out competitors. And so again, that can be very appropriate at times, but if that's the only way you're going to grow your business, by buying out competitors and buying back your stock and not making long-term investments in the future, then this is, again, not good for the long-term sustainability of the stock market and long-term capital gains. So that's, again, a chart that shows we want to be careful that most money is going into share repurchases and acquisitions. The fifth chart, we just look at a couple of foreign markets very quickly. The fifth chart just highlights some of the craziness in China. You've heard about this. If you read any of the newspapers or you look at, follow any of the news, you know that China has been expanding rapidly, both its growth and its debt. And the debt levels in China are just off the charts. And this chart helps show that Chinese lending really is out of control. And you can see the blue line, those would be bank assets or the bank loans. Those are the loans that the banks are giving as a percentage of GDP. In the last 8 years has gone from about 195% of GDP to almost 300%. And that's just a massive increase in terms of the lending on the part of banks. And you know that a lot of that lending is not going to be paid back. And you can see that at the same time, the growth in the Chinese economy has gone from about 15% in GDP growth. That's a nominal number. In other words, that includes inflation, all the way down to 6%, maybe 7%. So debt has been skyrocketing, economic growth coming down. Not a good recipe for long-term opportunities. The last slide that I just wanted to highlight deals with Japan. And I think most people know that Japan is a debt sinkhole. And to make matters worse, they have a massive aging of the population, more deaths than births, and virtually no immigration. So they've got some just huge systemic problems. And so if you look at this chart, it just shows you that the government debt as a percentage of GDP has just been growing. In fact, just the sovereign debt, this is the government debt, is well over 200% to GDP, which is virtually unprecedented in a developed economy. You can also see on the other line, which is a little darker below that, and you can see it just spiking right up, that's the amount of debt owned by the central bank. And what that means is that the central bank is just buying up all the debt or printing money. So that's just showing the record amounts of money that's being printed in Japan. And as we've talked about before, you cannot do this indefinitely. What is unsustainable will not be sustained. So we wanted to just give a quick update on some of those slides. I thought they were very helpful, that the slides that Stanley Druckenmiller gave at one of his conferences recently. There was some other slides, but we've just pulled out 6 slides that we thought were very apropos to remind our investors, let's be careful, let's be vigilant. That's exactly what we continue to do. And we own great companies, continue to add to great companies, and trying to be very attentive to valuation. So I have another update. I'm going to just talk a little bit about the gold market in a couple of days, and that'll be coming out shortly. But in the interim, if you have any questions and you want to contact us, you've got all our numbers. Please reach out. We'd love to hear from you. Thank you very much. Bye now.